The final trading day of August closed with a wave of red across the financial markets, underscoring a month that tested investors' resilience. Nowhere was the pressure felt more acutely than in the semiconductor sector, where giants such as Nvidia and AMD fell nearly 4% each. The drop came against the backdrop of a development in China that could reshape the landscape. Alibaba announced its own artificial intelligence chip production, raising the possibility that Chinese firms may no longer rely as heavily on US technology. For Nvidia, AMD, and their peers, the news injected fresh uncertainty into an industry already known for its volatility. As August gave way to September, analysts turned their gaze toward historical patterns. Since 1928, September has been statistically the worst-performing month for the S&P 500. Yet despite this historical headwind, market sentiment showed a strikingly optimistic tone. Analysts, using their 1 to 5 scoring system, with 1 representing a strong buy and 5 a strong sell, leaned heavily toward bullishness. The consensus suggested not only optimism for the near term, but also confidence in the beginning stages of a new bull market. Among the most outspoken voices was Tom Lee, who argued that the current bull market is not only real but also capable of stretching across the next decade. While he acknowledged the possibility of a short-term correction, he emphasized that such dips would likely be brief, paving the way for new all-time highs. The backdrop of anticipated rate cuts in the upcoming Federal Reserve meeting further bolstered investor confidence, setting the stage for fresh buying opportunities. Against this atmosphere of optimism, 5 stocks emerged as particularly noteworthy candidates for September. The first of these was Marvell Technology. The company had recently reported earnings, missing revenue expectations slightly while delivering earnings per share largely in line with forecasts. Yet a deeper examination revealed that year-over-year earnings per share had surged in triple digits, and revenue was up 58% despite the headline miss. Over the past 5 years, Marvell's data center segment grew at a compounded annual rate of 41%, with the most recent quarter generating nearly $1.4 billion. Still, the company's stock suffered a harsh market reaction, shedding nearly 1/5 of its market capitalization in the wake of the earnings report. The sell-off highlighted the cyclical nature of the semiconductor industry. Marvell's management openly described growth as non-linear, a reality common in technology sectors tied to shifting demand cycles. Still, data center revenues continued to expand, reaching $1.5 billion in the latest quarter. The $200 million shortfall against Wall Street expectations sparked the punishment, but the company's long-term trajectory remained intact. Over the past year, Marvell's stock had fallen 10%, and year-to-date losses exceeded 40%. Trading near 52-week lows and far from its high of $127, the stock's valuation presented a compelling story. With a forward price-to-earnings ratio near 20, well below its historical average of 35, Marvell appeared undervalued in the eyes of both Wall Street and independent analysts, many of whom rated the stock a strong buy. The disparity between Marvell's intrinsic valuation and its declining share price raised the possibility of market mispricing. Institutions appeared to agree, with 84% ownership concentrated among them. While institutions had sold $11 billion worth of shares in the past year, they purchased more than $16 billion, including $4.6 billion in the most recent quarter alone. A discounted cash flow analysis placed Marvell's fair value near $84, suggesting roughly 33% upside. Even conservative assumptions yielded valuations in the mid-$70 range, while more optimistic models projected values above $90. For long-term investors, the margin of safety appeared compelling, especially given Wall Street's consensus target of 82. The second stock drawing attention in September came from a very different corner of the market: real estate investment trusts. Realty Income, known as the monthly dividend company, has built its reputation on consistent payouts, with a yield historically near 6%. In the past year, the stock had declined by 4%, but it rose 10% year-to-date. Over the past decade, total returns reached 35%, and the company continued to deliver growth in adjusted funds from operations, averaging around 5% annually. Trading near the midpoint of its 52-week range, Realty Income carried a double buy rating from independent evaluators and a near buy rating from Wall Street, with its price-to-AFFO ratio at 13.6, below its historical average of 15.6. The dividend yield of 5.5% was well above the long-term average of 4.9%. For income investors, This represented not just an attractive yield, but also a dividend considered 80% safe by analysts, supported by a history of steady increases. Institutions held 71% of the company, selling $3 billion in the past year, but buying more than twice that amount. Intrinsic valuation placed realty income near $65, suggesting a margin of safety around 9%. With anticipated rate cuts likely to drive investors back into income-generating assets, realty income remained a strong candidate for portfolios seeking stability and cash flow. The third stock to capture market interest was United Health Group. This healthcare giant, while often in the news for regulatory scrutiny, had drawn significant attention from super investors in the most recent quarter. 13 major investors, including Warren Buffett's Berkshire Hathaway, initiated or expanded positions, with Buffett's firm purchasing more than 5 million shares. Despite this vote of confidence, the company faced Department of Justice probes and other legal challenges that weighed heavily on sentiment. United Health's share price reflected this uncertainty, falling nearly 48% over the past year and 39% year-to-date. Yet even amid this decline, the stock saw a modest 15% rebound in the past month, trading near 52-week lows. Analysts remained cautiously optimistic. Both Wall Street and independent evaluators rated it a buy, while Buffett's involvement added further credibility. On valuation metrics, the company traded at a forward P/E ratio of 19, roughly in line with its 5-year average. Its dividend yield, however, was striking. At 2.9%, it stood far above the historical 1.4% average, supported by an 80% dividend safety rating and a recent 5% increase. Intrinsic valuation models offered two perspectives. For those who believed United Health's regulatory troubles were long-term structural issues, fair value sat around $300, close to current prices. For those who saw the issues as temporary, a discounted cash flow and dividend discount model combination yielded a valuation of $443, implying a 30% margin of safety. Wall Street's consensus target was $330, suggesting 8% upside, though analysts continued to trim forecasts. For value-oriented investors, United Health represented a divisive but potentially rewarding play, hinging largely on the duration and impact of its regulatory challenges. A fourth company stood out for its steady long-term reliability rather than near-term drama: Waste Management. The stock had risen 8% in the past year and 12% year-to-date, with an extraordinary 353% gain over the past decade, far outpacing the S&P 500. Known for operating in an industry unlikely to face disruption, waste disposal, the company consistently delivered moderate growth while maintaining relatively low volatility. Over the past year, the stock fluctuated within a narrow range between $200 and $240, reflecting its reputation as a defensive asset. Wall Street rated Waste Management a buy, and projections for the coming year included double-digit growth in 3 of the next 4 quarters. Analysts expected top-line revenue growth of around 10%, well above sector averages, and long-term earnings per share growth of 11%. With a forward P/E ratio near 26.5, the company traded at a premium, but rarely did opportunities arise to purchase the stock at a discount. Institutions held 81% ownership, selling $6.8 billion in the past year, but buying nearly twice as much. Intrinsic valuation models placed fair value near $213, close to current prices, while Wall Street projected $261, implying 15% upside. Though not a bargain, Waste Management remained a quintessential long-term hold, suitable for dollar-cost averaging strategies. The fifth featured stock was Restaurant Brands International, owner of Burger King, Tim Hortons, and Popeyes. The company's stock declined 8% over the past year and 3% year-to-date, though over the past decade it returned 69% with dividends reinvested. Currently trading near the lower end of its 52-week range, Restaurant Brands carried double buy ratings from both Wall Street and independent analysts. With a price-to-earnings ratio of 16.4, well below its 5-year average of 20.6, the stock appeared attractively valued. The company's dividend yield hovered near 4%, above its historical average, but safety was less certain, rated at 45 out of 100. Free cash flow payout ratios were expected to exceed 100% in the coming year, a red flag for sustainability, though management's decision to raise the dividend by 7% earlier in the year suggested confidence in their outlook. Debt levels had improved significantly since 2020, when net debt to EBITDA ratios exceeded 7, and were expected to fall toward 5. Institutions appeared confident, purchasing $4.4 billion in the past year, more than double the $2.7 billion sold. Intrinsic valuations placed fair value near 77, with a margin of safety approaching 19%. Wall Street targets mirrored this, also placing the stock at 77 and projecting 22% upside. Beyond these 5, several other companies remained on investors' watch lists. ASML, a leading semiconductor supplier, fell alongside Nvidia and AMD but maintained a buy rating from analysts. Novo Nordisk, down nearly 60% in the past year, also appeared attractive to some. Salesforce and Eli Lilly drew attention, with the latter seeing significant insider buying. Even Berkshire Hathaway, though facing leadership changes with Warren Buffett stepping back, earned buy ratings from analysts. For those seeking broader semiconductor exposure, exchange-traded funds such as the VanEck Semiconductor ETF or the SOXX ETF offered alternatives. As September unfolded, markets balanced historical caution with forward-looking optimism. With anticipated rate cuts, strong institutional buying, and analysts leaning bullish, opportunities abounded across diverse sectors. From semiconductors to healthcare, real estate to waste management, the coming month promised to test both patience and conviction. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. We hope you found this video helpful. If you did, please like and subscribe to our YouTube channel so you don't miss out on future uploads.